Welcome back to Smart Stock Sam, where we cut through the noise and find the stocks that actually matter. Today, we are diving deep into NIO. Is it finally breaking out, or is this just another head fake from one of the most controversial EV stocks on the planet? NIO just shattered a record that almost nobody saw coming. Their CEO has gone on record with a bold profit target, and institutions are pouring money back in, fast. Could this be the moment NIO stops being a story and starts being a paycheck? Stay with me, because by the end of this video, you will have everything you need to decide whether NIO belongs in your portfolio right now. Let's rewind for a second, because to understand why this moment is so significant, you need to feel the weight of what came before it. Since 2014, NIO has been, frankly, a professional cash-burning machine. 11 straight years of losses, a stock price that collapsed 90% from its all-time highs, bankruptcy scares, skeptics writing the eulogy every single quarter. And yet, here we are. Because in the fourth quarter of 2025, NIO did something that analysts called flat-out impossible. They issued a profit alert for an adjusted operating profit between $100 million and $172 million. That is the first time in the company's entire history they have stayed in the green. We are watching a company transition in real time, from survival mode to scalability mode. And while those headline numbers look incredible on their own, there is one hidden metric I'm going to reveal in just a moment that completely reframes how you should be valuing this stock. So don't go anywhere. Now, here is the question everybody asks. How did they pull this off without just slashing costs and hollowing out the company? The answer is the moat, and it is bigger than most people realize. NIO has built something that no other EV manufacturer on Earth can replicate overnight. 3,750 power swap stations spread across China and growing globally. As of February 2026, they have completed over 100 million cumulative battery swaps. Think about that number for a second. 100 million. During the Chinese New Year rush alone, they were processing over 165,000 swaps in a single day. That is not just impressive logistics. That is customer lock-in at a massive scale. Every driver who uses a swap station is feeding NIO data, loyalty, and recurring revenue. But here is where it gets really interesting. NIO has cracked open their ecosystem. Industry giants like Geely, Chery, and GAC Group have now adopted NIO-S battery swap standards. NIO is no longer just a car company. They are becoming the gas station for the entire Chinese EV ecosystem. And when you own the infrastructure that your competitors depend on, that is a completely different kind of business. Could NIO become the de facto energy backbone for EVs across Asia and eventually the world? It sounds ambitious, but the data is already pointing that direction. If the infrastructure is the foundation, then the car sales are the skyscraper built on top of it, and that skyscraper is rising fast. In 2025, NIO delivered over 326,000 vehicles. That is a 46.9% jump year over year. In December alone, they set a single-month delivery record, crossing 48,000 units. But NIO is not content staying in the premium lane. They are simultaneously going mass market with Firefly, their new sub-brand targeting everyday European consumers, with showrooms already opening in Denmark. Attack from above with high-margin luxury vehicles, attack from below with high-volume entry-level cars. If that two-pronged strategy works at scale, could NIO be the first Chinese EV brand to genuinely crack the Western consumer market in a meaningful way? That is a question worth sitting with, because the answer could be worth a lot of money. Now, if you really want to know where a stock is going, you do not watch the retail traders. You follow the institutions, the ones with the research teams, the data rooms, and the billion-dollar conviction. And right now, the smart money is moving hard into NIO. D.E. Shaw & Company, one of the most sophisticated quantitative hedge funds on the planet, more than tripled their position in NIO at the end of 2025, making them the largest institutional shareholder. On top of that, Abu Dhabi-backed CYVN Holdings is holding a massive 21.7% stake, providing the kind of capital stability that keeps a company alive through macro storms. The market noticed immediately. Following the profit alert, NEO's stock surged 10% in a single day. Investors are finally shifting the conversation from how much cash are they burning to how much margin are they capturing. That is a fundamental shift in how Wall Street sees this company. And historically, when that shift happens, it happens fast. But before you rush to your brokerage account, let's talk about the landmines, because there are real ones, and you deserve to know about them. First, China is rolling back EV subsidies. That policy shift is putting upward pressure on vehicle prices and cooling consumer demand at exactly the wrong time. Second, the trade war is still very much alive. High tariffs in the US and Europe are a serious barrier to global expansion velocity, and NEO's Firefly ambitions in Europe could hit a wall faster than expected. And then there is BYD, 4.6 million vehicles sold in 2025. NEO, at 326,000, is a boutique player by comparison. NEO's bet is that premium service, ecosystem lock-in, and infrastructure dominance will insulate them from BYD's ferocious price war. It is a logical strategy. But is it enough? Could BYD simply decide to build their own swap network and make NEO's moat irrelevant overnight? That is the scenario that should keep every NEO investor up at night. And it is one that deserves a straight answer before you put real money to work. So what does all of this actually mean for the valuation? CEO William Li has staked his personal reputation on a single, audacious goal: full-year profitability in 2026, not adjusted, not one-time items, real, sustained profitability across all 4 quarters. If NEO hits that target, the entire valuation model for this company changes overnight. Right now, NEO's stock is trading near what many analysts consider a valuation floor, below $5 per share. The market has already priced in the risk of failure. Years of losses, multiple near-death experiences, the worst-case scenario. It is all baked into that price. What is not priced in is a successful profitability turnaround. What is not priced in is NEO becoming the infrastructure standard across Asia and beyond. That asymmetry, where the downside is limited because failure is already assumed, but the upside is enormous if the pivot succeeds, is exactly the kind of setup that creates life-changing returns for investors who get in before the narrative shifts. The question is whether you believe the pivot is real. Before we get to the final verdict, a quick but important note. Nothing in this video is financial advice. I am not a licensed financial advisor, and this content is purely for educational and entertainment purposes. Every investment carries risk, and you could lose money. Always do your own research and consult with a qualified professional before making any investment decisions. The views expressed here are my own and do not represent any financial institution. Here is the bottom line from Smart Stock Sam. NEO is 3 things at once right now. It is an infrastructure leader with a moat that competitors are actually paying to use. It is an operational scale story with delivery volumes accelerating in both the premium and mass market segments. And for the first time in 11 years, it is a financial turnaround story with institutional backing, a profit alert on the books, and a CEO who has drawn a line in the sand for 2026. But make no mistake, this is a high-volatility, speculative play. If you are looking for a calm, steady compounder, NEO is not it. But if you have the risk tolerance for the swings, the conviction in the infrastructure thesis, and the patience to let the profitability story play out, NEO is my major bet for 2026. The moat is real. The partners are real. The first profit is real. The pivot is working. The only question left is this: are you going to recognize the opportunity before the rest of the market does? Drop your thoughts in the comments. Are you buying the dip, or are you fearing the tariffs? I want to hear from you. And if this breakdown added value, hit that like button and subscribe to Smart Stock Sam, because we have got a lot more high conviction analysis coming your way. I'll see you in the next one.